Hello everyone. Today this video we are going to talk about marginal cost of fund based lending rate, which is also called MCLR. So what is MCLR? Now you must have heard this term in quite number of economic articles. MCLR is the internal benchmark rate used by banks to fix the interest rate on floating rate loans. Now there are two types of loans: fixed rate and floating rates. So all the loans which are given on floating rate basis are governed by MCLR. And when did it start? Started from 1st of April 2016. All the banks in India are required to benchmark and price their loans to MCLR. I hope this point is absolutely clear. Now MCLR is lending rate calculated based on the cost of raising new funds for the bank, which include the cost of maintaining CRR, SLR, operating cost of the banks, and tenure premium. Now this is something which we need to understand. How is it calculated? Now it is calculated on based of raising new funds from the bank, right? For the bank, which includes the cost of maintaining CRR, SLR, operating cost of the banks, and tenure premium. So whenever a bank gives loan to the customer, the bank has to raise the fund. Now imagine if the bank has to raise the fund from the market. So what is the cost that the bank is paying to raise the new fund, right? Now this cost will include the cost of maintaining CRR, SLR, because as per RBI norms, every commercial bank has to maintain CRR and SLR, and there is a cost to it, because out of 100 rupees you have to take out certain percentage in form of SLR in 100 and CRR. That has a cost. Operating cost, every bank operates, which has a cost, and also tenure premium, for how long the fund is being raised. So as MCLR is closely linked to repo rate, it improves the transmission of RBI's repo rate cut to the end borrower. Also the MCLR is somewhere closely related to repo rate, and repo rate is something which is actually the rate which RBI wants the banks to give it to the customers, the borrowers. Now bank publishes MCLR for at least 5 durations, which are overnight, 1 month, 3 month, 6 month, and 1 year MCLR. So whenever a floating rate of interest is given on a particular loan, this period of MCLR is also mentioned. So if it is 1 month MCLR, every month MCLR, if it changes, the floating rate will be adjusted as per that only, right? Now interest rate on each floating rate would be reset based on the duration of the MCLR to which it is linked. That is the point which I just said. It will depend upon the duration of MCLR, whether it's 3 months, 6 months, 1 year. It will be mentioned in the sanction letter. Now, which loans are linked to MCLR rate? Floating rate loans are linked to MCLR rate with effect from 1st of April 2006. We have already discussed this. Typically, home loans and loan against property schemes are floating rate loans and benchmarked to MCLR rate. So you can see on the left hand side on the chart, home loan and loan against property are basically floating rate, and hence they are linked to MCLR. Other type of loans like personal loan, business loan, gold and car loan, they are based on fixed rate. So they are not governed by MCLR. Now some banks offer fixed rate home loan and property loan under special schemes. Personal loan, business loan, car loan, gold loan are mostly fixed rate loans and are independent of MCLR rate. Now how does MCLR rate works? What is the reset frequency? What is the spread? And how it happens? Now floating rate on your home loan is a function of two parameters. One is the reset frequency of the interest rate, and the other is spread on the benchmark. Now you will study these two parameters in details. Now these two parameters together will determine the interest rate you will pay on your home loan, mortgage loan, or business loan. So let's study reset frequency. The applicable MCLR rate will be the rate corresponding to the interest rate reset frequency of the loan. Now, whenever you take a loan, you will get a reset period. That means after what time your loan will be considered for a revision in rate of interest. So a home loan with a reset frequency of every 1 year will be priced with the 1 year MCLR as the benchmark, and a home loan with 3 months reset will be priced as per 3 months MCLR as per benchmark. Simple. So whatever MCLR you will choose, 1 year, 3 months or 6 months, accordingly it will be reset, right? Let's talk about spread. The next component is spread or the margin that you pay over the bank. MCLR for a particular loan type of the bank. Margin would be fixed at a time of sanction, and it would change only if there is significant change in customer credit profile. Now margin is also something which the customer needs to pay on the rate of interest, and that will only take if there is significant change in customer profile. That is his credibility, his rating. For instance, Bank A has 1 year MCLR of 9.1 and a spread of 0.2 for home loan. So the interest rate now will be charged in case of the customer as 9.3, that is 9.1 MCLR, which is for 1 year, plus 0.2 of spread, which will eventually come to 9.3, right? So these two factors play a very important role for deciding MCLR: reset and spread. Reset is the tenure of MCLR and spread is the rate of interest which is charged if there is a significant change in customer profile. It is the margin. Now how does it happen? When a bank changes its MCLR, the interest rate on your floating rate home loan will also change? Yes, because it is dependent on that. Banks typically adjust the change in floating rates by changing the loan tenure and by keeping the EMI constant. Normally the banks when there is change in the rate of interest of the floating rates, they change the loan tenure. So if there is reduction, they will reduce, the loan tenure will be affected accordingly, right? So the EMI will be same, the amount which you are paying, but the rate of interest will, the tenure will decrease. So in most cases, the cut in home loan rate might not result in lower EMIs, but your loan tenure will be reduced. So why MCLR loans are more transparent as compared to base rate loans? Now MCLR rate is more transparent and customer friendly as compared to base rate. Why? Because MCLR is calculated based on the cost of raising new funds, and also it allows to have differential rates based on the underlying tenure of new funds. So it's basically giving more opportunity to the customer to avail the benefit of changing rate of interest, right? Cost of raising new funds for bank is closely linked to the repo rate, which makes MCLR rate more responsive. As we have already studied this, repo rate is the rate which RBI wants the banks to charge from its customer. MCLR of bank is revised every month as compared to base rate, which is revised every quarter, which makes MCLR more dynamic as compared to base rate. This is also an important factor. So I hope this video would be very informative and you must have learned a very important concept today.